Kindly note that the views and opinions shared in this video are those of the speaker and do not constitute advice given by Classic Private Wealth. Any advice given by Classic Private Wealth will be in writing in the form of a wealth management proposal. Classic Private Wealth is an authorized financial services provider.
So what I thought about to do today is to just step back and not focus on the events of the day. So every day we're overwhelmed by events and speeches and things that happen. And it feels like we're in a very different world from the one where we were just a couple of months ago. I was watching this clip yesterday of the guy looking at the crystal ball and then telling his client not to touch the crystal ball. But if you think about, if you describe people's lives today, then it's actually very different from what you would have expected just 6 months ago. Working for months on end in your tracksuit pants might not have been something that people realistically thought they would do. So I thought that what we would do is we would step back and just have a look at the longer term trends and the longer term principles in order to make sure that we don't get so sucked into the moment that we forget about the general principles. So my own view is that what you do is always more important than what happens out there. And if you consistently do things that will give you the right result eventually, then you will get the right result eventually. But I thought it would be interesting to just have a look at the 21st century. We all started the century a little bit nervously because of the Y2K bug, which turned out not to be too much of a serious virus. But what we've seen since has been actually quite unusual, and there are some longer lasting lessons we can take out of it. But before I kick off with that, what I want to do is to just actually give you an idea of how investments behave through the economic cycle. And in essence, one of the things that we find is that the long-lasting changes to the value of various assets are typically driven by changes in inflation or changes in the growth rate of the economy, and I'll explain that in a little bit more detail. So I'm just going to go onto my notability and draw a little bit of a graph. Being an economist, I can now indulge myself and start drawing stuff on the computer. So what you will see is that if I think about the growth rate in the economy, let's just, if you should be seeing a blank piece of paper with a cross on it in front of you.
Not yet, Wikus. I've just got all the people's initials on.
Yeah.
So the sharing is taking a little bit of time. We'll get there in a moment, I'm sure. Let's have a quick look. Okay, shall we just try again? Yeah, what I'm going to do is we'll try to fix the sharing of this notability in a moment, but I'll just talk about it for a second. What happens is that various assets are influenced in different ways by changes that are in inflation and changes in interest rates. So if you're thinking about asset classes, most economists will say to you that there are really 4 asset classes if you're thinking in a global fashion. There are 4 different things you can invest into. The one is shares or equity, meaning that it's the normal thing that people invest into, listed shares. The second is bonds. Now, this is something which is not so conventional for individual investors. Most individual investors don't actually participate in the bond market regularly, but pension funds and insurance companies do participate in that market in a big way. So the government, when it borrows, doesn't borrow from banks because it's more creditworthy than banks, so it borrows directly from the large institutions, and they do so in the form of government bonds. And most of those government bonds are so-called fixed interest bonds, meaning the way that it works is you receive a piece of paper which promises to make certain payments to you over a long period of time, and those payments are fixed, meaning we are, okay, now we seem to be getting some sharing. Okay, we are back on track in terms of the sharing. So the third thing that you can invest into that has a different behavior pattern is gold. Now, gold, interestingly enough, although it's technically a commodity, it doesn't really behave like other commodities. Gold is something that over a long period of time has been used as a currency. So it actually behaves more like a currency, but it's a currency with 2 very specific characteristics. And the first characteristic is that it doesn't pay any interest, so there's no yield. And the second characteristic is that you can't just print gold. You have to dig it out of the ground at great cost and effort, so it doesn't become more at a very rapid rate. So it's a very specific kind of currency, if you like. And the third thing is, or the fourth thing is commodities. So if we're thinking about investments, we're really thinking of 4 classes of investments: equity, first of all, secondly, bonds, and really we focus on government bonds, thirdly, gold, and fourthly, commodities. And we'll have a look in a moment at how those things performed over the 21st century up to now. Lee, can you tell me whether you're seeing what I'm writing?
Yes, I can, and I thought that was either Salvador Dali or Picasso writing up there.
Yeah, well, Picasso was famous for paying his bills at restaurants by drawing a picture on a napkin quickly. So maybe I can draw a graph on a napkin quickly and get paid. It'll be accepted as payment in restaurants at some point, but I still have to get a lot more famous before then.
It's fine. It's great. No problem.
So what you actually see is that if you now plot the behavior of those asset classes on a graph where on the one side, up and down, you've got economic growth. So positive and negative economic growth on the one axis, and on the other axis you have inflation. And then you have positive and negative inflation. What you find is that if you now define things, this is what economists do, they define things to be a certain thing. If you define the current expectation about growth and inflation as being the origin of this graph, then you have 4 quadrants, and you will see that the behavior of your 4 asset classes are different in the 4 quadrants. So if you have a situation where growth is exceeding the expectations, and inflation is also exceeding expectations, So this would normally be associated with strong growth in demand for some reason. So if you think about the 1960s, when in the US they were trying to fight the Vietnam War and not raise taxes, and they had a very young population just coming, the baby boomers were just starting to buy homes, so you had very strong demand. You had a situation where inflation was accelerating, but growth was also accelerating. So in that situation, what you typically find is that equities do well because there's lots of growth in the economy, so it's easier to make profits, and that translates into positive returns for equities. Then bonds in that kind of situation, because of the accelerating inflation, the future payments that you receive on your bonds may be worth less. Therefore, bond prices are likely to go down. So bonds have a minus. And at the same time, you'll find that commodities, because of the high demand, will do well, but and gold will also do modestly well. Although interest rates will be rising, so yeah, gold could go either way if you like. Then you get the opposite of that, and really the opposite of that is what we saw in the 10 years following the credit crunch. And it's really something that is associated with lack of demand. If there's just not enough demand. Now, after the credit crunch, most individuals and most banks were under a great deal of balance sheet strain, so there was just not enough spending. At the same time, as we'll see, the baby boomers are now moving towards retirement, so they don't really want to spend as much. They want to start saving for the retirement. So we actually had a period during which we had a lack of demand. So what we had is lower inflation than expected and lower growth than expected. So in this environment, equities will do worse than expected. So what is worse than expected? What you would normally expect of equities is to beat inflation by about 6% at a gross level. So that 6% more than interest rates is actually called the risk premium. So any time that equities underperform the inflation plus 6% mark, that's an underperformance for equities. So there you see equities negative, but bonds do very well, and gold in this kind of environment actually does reasonably well, but commodities does badly. So we'll see in the graphs just now how those things turned out after 2008. But effectively, these are the two quadrants that economists would have identified in the late 1960s, and they would have said you will always be in either of those. So if you have a portfolio with equities and bonds in it, you are okay, because either your bonds will do well or your equities will do well. So you don't really need commodities and gold. And then, of course, the 1970s came along. And what happened in the 1970s is that you actually had high inflation and low growth at the same time. And this was caused, for those of you with long memories, this was caused by the spike in oil prices, which meant that inflation got something called cost push inflation rather than demand pull inflation. So actually you had a situation where equities did badly and bonds did badly at the same time, because inflation was also accelerating to quite extraordinary levels. So you had a period where in the United States inflation was 14% per year. So that's not a good environment for bonds. So actually your diversified portfolio of equities and bonds didn't do well at all. But boy, if you had a little bit of gold, did that rescue you, because gold actually did phenomenally well in this environment. It started the 1970s at $35 an ounce, where it had been since 1944 under the Bretton Woods system, and it ended the 1970s at $850 per ounce. So basically a 20-fold or more increase in the price of gold. And of course, oil prices also did really well, so commodities did really well as well. So if you had some allocation to commodities, it rescued your portfolio in that situation. And then, of course, you also get something that is technically called Goldilocks, not too hot and not too cold, if you remember the 1990s. So in the 1990s, you had a situation where you had very fast growth, but low inflation at the same time. And it was really caused by a supply shock, but a positive supply shock, because with the fall of communism, an extra couple of billion people joined the capitalist economy. So what you have is you have a situation where equities did well, actually very well. Bonds also did well. So your diversified portfolio of yours would have done phenomenally well, because both parts did well. But you actually had commodities doing reasonably well and gold doing badly during the 1990s. So the things that you used for extra diversification didn't come to your aid in the course of the 1990s. So in essence, what we would say is you will always find yourself in one of these quadrants, and you'll have that combination of performance from your variety of investments. Now, what you can see here is that the traditional thing for individuals is just to invest into commodities and or into equities, and that will really serve you well as long as there's good growth in the economy. But we now know that good growth is not something that we can accept as normal for our economy, and therefore we should be diversifying into other things as well. And we'll get to that again when we look at the history of these asset classes over the period. So there's the prescription. So if that's what you do, the basic prescription is to invest into 40% equities, 40% bonds, 10% of gold, and 10% of commodities. And then what will happen is you will be prepared for any one of those scenarios. And if you then rebalance between those, because remember, if you had a fantastically high gold price through the 1970s, if you didn't sell some gold and buy the cheap bonds and equities, you never got the full benefit of having gold in your portfolio. So rebalancing is an important part of what we need to do. So much for the theory. Let's look at what happened in the 21st century. So we can leave the drawings behind, so Picasso can become less nervous, and we'll have a look at some PowerPoint graphs and just see what happened in history. Just while we getting the graphs up, one of the alternatives as an economist that you always consider is to predict into which of those quadrants you will be moving. So the first thing that I like to do when we start talking about the 20th century is to say that the 20th century has actually taught us some lessons from an economics point of view. And the main lesson is it's extremely difficult to predict what will happen in the economy in the medium term. So if you think about it, we entered the century on a very optimistic note. People thought that most of the political problems of the past have been put behind us, so the end of history, and that we will be nicely cooperative and we'll solve all the world's problems. So the Millennium Development Goals, etc., part of that optimism. But what struck us at the beginning of the 20th century, and what you should see in front of you is a graph. And on that graph, there are two lines. The one is a blue line, which is the Federal Reserve, the federal funds rate, basically the rate that the Federal Reserve charges the American banks. And what you can see is we entered the century with a rate of about 5%. Initially, the rate went up to more than 6%, which meant that you had quite a good return on your money if you were just putting it into the bank. But we then see a precipitous fall in that interest rate from 6.5% to about 1.5% very quickly. And the cause of that is twofold. The one part of that is caused by the collapse of the dot-com bubble, which actually spilled into the general economy as a recession. And the second thing that happened is the incident of 9/11. So at the height of the recession, we also had a big political shock, and we had to revise the way we live in terms of security. So if your surname was Marais and you came from somewhere in Africa and you were traveling through the United States in the early 2000s, you happened to be the randomly selected person from the line at the airport every single time. And so the first 3 times it's kind of a joke, and then by the 12th time it's no longer a joke. But anyway, what we see is there's a big shock to the economy initially, and the thing that we would say from an economics perspective is there's nothing in our economic modeling that predicts an event like 9/11. So you can have political theory, etc., but even if you knew that an event like 9/11 was inevitable, you would have been wrong for 20 years and then right. So it's not very useful from an investment perspective to have known that an event like 9/11 would happen at some point. What you needed to do is to know when it would happen. So effectively, there's a massive event that affects the economy massively that's not included in your forecasts. The second thing that happens is, of course, the credit crunch. Now, again, if you were studying economics, you would have thought that bank shareholders and bank management would not lend money to people who are essentially bankrupt, and that they would try to protect themselves, and that's what Alan Greenspan did. He therefore said we don't really need to regulate the banks that heavily because they need to look after themselves. They've got a strong incentive to look after themselves. But actually, lo and behold, as interest rates fell in the mid-2000s, we actually get a situation where there's far too much money being lent to far too weak credits. So that second precipitous fall in interest rates is the reaction of policymakers to the credit crunch. And you see that interest rates stay virtually zero for close on 10 years, around 8 years. For roughly 8 years, interest rates in the US stay at roughly zero, and then they go up to 2.5% briefly, and then we see that last fall to zero is obviously the reaction to the current COVID-19 crisis. So what you see is actually a period of extraordinary low interest rates, but 3 really unexpected events. The first is the 9/11 thing. So the dot-com bubble, I guess you could say, was more of a normal economic event, but still it was a surprise when it happened. And then secondly, the credit crunch, which was a very unusual event, the biggest credit event in about 70 years. And then the COVID-19 crisis, completely unpredictable. So again, if you look at the videos of Bill Gates from 2015, The idea that at some point a virus might strike us has been around for a while. The problem is we never know when. So again, to be useful for investment purposes, we needed to know the when. So what I would say to you is 3 big events that would be virtually impossible for an economist to predict. So the conclusion we have is predicting these events is not very useful. So what you have to do is to construct a portfolio that will give you roughly similar results no matter which of those 4 quadrants you find yourself in. So a balanced portfolio that gives you similar results for the various quadrants seems to be the right thing to do. So let's move on to having a look at the, so firstly, just a quick comment. The first thing is that you actually end up with a situation where interest rates in general has been negative more than positive over the last 20 years in the US. So what that would lead you to say is actually the risk-free rate in the investment markets were negative most of the time, and therefore you would expect lower returns across the board if your risk-free rate that you start off with is negative. So let's have a look at how our 4 asset classes perform. So firstly, the equity markets, which is still the go-to for most individual investors. And what you see here is a situation where we've got 2 graphs. The one graph shows the actual behavior of the equity markets, and the other graph shows the downdraft, meaning how far did the markets go down from the top. So what you see in the performance graph is there are 2. The first thing that would strike you if you look at this is that you had an overall return over 20 years of 4% per annum from the beginning of the century to now. So one of the things that has struck me over time when you look at the returns on various assets is that if you look at equities, your starting point is incredibly important. So if you start at a fairly high point for equities, such as the turn of the century, then your long-run returns are not what you would normally expect. So remember now, if we had an average inflation rate of, say, 1.5%, we're only ending up with a real return of about 2.5% over a 20-year period. So actually a period of very disappointing returns for equities globally. So this is now the MSCI All World Index, meaning these are global equities we're talking about, which, by the way, is made up about half by American equities, about 30% by other developed countries, and about 20% by developing countries. So actually a disappointing return overall. And at the same time, you then see 2 very big downdrafts. So you see a downdraft of very close to 50% in roughly 2002. But the other interesting thing that you see there is that you see that the bear market lasted for at least 18 months. So actually a gradual fall in markets. And then when you get to the credit crunch, you see another fall, and this fall is even larger percentage-wise. So you see a fall of very close to 60%, 58.5%. Fall from top to bottom in the course of 2008. So what you see is that equities actually on this evidence is not a very attractive thing to invest in the sense that you've had 2 incidents of very large downdrafts and a very modest return overall. At the same time, what you see is that we had roughly a 35% downdraft in markets in March this year, but actually a very strong kickback. So when you look at the recent incident in markets, it's quite a strong downdraft, but very brief. So something that is, again, quite unusual. So if we now move on and say, given that equities were not very attractive, what was the alternative? So the first alternative was to invest into government long bonds. And the interesting thing is here we have a much better picture. So the first thing that you would say is here we have an 8.5% per annum return over the 20 years. So bonds actually offered us roughly double the returns that equities actually offered us. So effectively what you would think is that we spent most of this time in the bottom left-hand quadrant of the quadrants we drew just now, meaning we had disappointing growth and slower than expected inflation. And if you think about the 20 years as a whole, that is actually true, and therefore it's not such a big surprise that we actually had bonds outperforming equities. And what we see is we actually had a drawdown in equity, in bonds, around about the time of the credit crunch. So in fact, that's a bit of a strange event, a small anomaly, if you will. So we had the biggest, a very big drawdown. So in 2008, we actually see close on a 30% drawdown for long bonds, which is actually a very big drawdown in bond terms. And what we've got to do is to explain that drawdown, because that drawdown came into the teeth of a recession. So normally what you would expect is that bonds would do well in a recession because actually interest rates are falling, and therefore we would expect bond prices to rise. Now, the explanation for that is that there was actually a very strong liquidity contraction around about 2008. Because it was a credit event, what you found is that anything except cash became very illiquid, and therefore people were liquidating even their government bonds in order to be able to pay their margin calls, etc., on their equities, which was going down 60%. So even when equities was going down 60%, you still had bonds going down 30% as well. But bonds, of course, ticked up much sooner. So by January 2012, you see that you've made all your losses back, and you still have significant gains through the rest of the period. So a very positive period for long bonds, with the interruption that actually at the same time that you had equity losses, you had some bond losses as well. If we now move on to gold, we see that gold actually performed better than either bonds or equities. So maybe those gold bugs who say that gold is the only thing to invest in, you should always, you should throw out everything else and only have gold in your portfolio. What you see is you see a very brief interruption, a drawdown of about 25% in the gold price just in the middle of the credit crunch. So again, the liquidity crunch that we experienced during 2008, 2009, affecting even gold. So effectively, you get everything going down at the same time, roughly in 2008. But what you then see is that gold actually very quickly returns to value and has a strong run until it actually flattens out after about January 2012. So after 2012, gold really going nowhere much. So the bulk of your returns on gold actually came in the first 10 years of the of the 2 decades. And the second thing is you actually have quite a large drawdown. So you have roughly a 40% drawdown in gold from 2012 to 2018. Actually, 2015 is roughly the bottom of it. So again, quite a lot of volatility. But what you can see is that gold now behaves nothing like the equities and the bonds. But of the three assets up to now, gold over the period giving us the highest return. What about commodities in this environment? And commodities, you see, is really the runt of the litter, not very exciting at all, in the sense that it gave you even less of a return over the period than you would have had on equities. So again, it kind of displays the behavior that you would expect from a period of lack of demand. Now, again, if you look at the commodities, you could actually look at this in terms of two different periods. The one period is from January 2000 to January 2008. So over that 8-year period, you actually see a fourfold increase in commodity prices. This is the so-called commodity super cycle. And one of the things, if you recall, is the rand was extremely strong over this period. So the strong rand would have been driven by this very strong performance of commodities, which is our main export. But what you would then expect is that you would actually expect in the second half of this period, where the commodities basically had a massive drawdown, and you can see there the drawdown actually goes to minus 74%. So you would have lost 74% of the money that you had invested into commodities in January 2008. What you would expect if you were to look at this is you would really expect the South African stock market to perform abysmally, and you would expect the rand to be weak over that period. So if you're thinking about the performance of South African investments, you really need to look no further than this graph for the explanation. And I've done some inquiries, and I'm told that the fact that Jacob Zuma was elected president of South Africa in roughly 2008 and actually was removed in roughly 2019 has had no influence whatsoever on this graph. So politics in South Africa actually didn't make a massive impact on this stuff. It's commodity prices globally that's driving the general trends. So for those of you who have had terrible returns on your South African equity portfolios, here's what's the cause of it. And basically the conclusion is the problem is not South Africa, the problem is an undiversified portfolio because you're living in an economy that is so heavily influenced by the course of commodity markets. But what you can see is that, again, the behavior of commodities very different from the behavior of the other three asset classes. So as a diversifier, it would have added value to your portfolio. So the question now becomes, how do you actually act in this situation? And the conclusion we've come to is what you do is you actually have to start diversifying your investments between the four different asset classes. So there you see the four different asset classes in gray and a combined portfolio of 40% equity, 40% bonds, 10% gold and 10% commodities. Remember now, this is a dollar portfolio that we're talking about. This dollar portfolio would have started at 100 in January 2000 and would have given you a 7% annual return. So a very acceptable return over the period, real return of about 6%. So you're earning roughly the risk premium. And when you look at the drawdown, you see that the gray drawdowns are actually very large from time to time, but the combined drawdown never really exceeds 20% by a large margin. So in the liquidity contraction that you got in 2008, your portfolio would have lost about 25%, 26.3 at the maximum, and it would have sailed through the rest of the period pretty much unharmed. So actually, as an investor, this looks like a very interesting and very attractive proposition. The question is, can we actually still improve on this? So let's have a look at the next graph, where what we actually do is, apart from just actually investing in at times when or into a diversified portfolio, what you actually do is you only invest when volatility is low. So what you do is you only invest this. Well, you can measure volatility, and effectively what you do is you only invest when volatility is low. And whenever volatility becomes high, you actually go into cash. So that would actually, you would expect that to lower your volatility, but it actually only lowers your volatility slightly. What happens is that you sail through that period where you would have had the 26% drawdown. You actually have a 10% drawdown, but you pay for this through the fact that you have a lower return. So the portfolio that only invests 60% of the time still had virtually the same return, so 6.4 versus 7.2, but it actually sailed through the period of volatility in the 2000s with very little drawdown, having a maximum drawdown of 10% actually early in the 2000s, not even in the credit crunch. But that's still not an optimal portfolio. If we were to adjust it slightly again, what you can then do is, given the very low volatility in the portfolio, what you might want to do is to gear up the portfolio a little bit. And the way you do that is you make use of derivatives. So you typically use derivatives to gear up a little bit. But it still doesn't give you a massive volatility. You see that if you now say that 60% of the time when volatility is low, you actually have a portfolio that's geared 1.67 times, and the other 40% of the time you spend in cash. So you are on average exposed 100% of the portfolio to the markets, but more exposed in the periods when markets are stable. And what you see in that portfolio then is that it still has a lower drawdown, but the drawdown actually comes at a different time from the one in the diversified portfolio. But so you still have a maximum drawdown of 21.4%, that's the blue line, but you now have a higher return. You have a 9.3% return versus a 7.2% return. So this looks like a very attractive portfolio. If we were to just look at the last graph that we've prepared, is we've just said, how does it compare to investing into equities only? Because what we find is that most of our clients have got portfolios that pretty much are invested in equities only, or into so-called 60-40 portfolios, where 60% is in equities and 40% in ungeared bonds. So if you compare a diversified portfolio with a speed change, if you like, or a change in the exposure to markets when volatility is higher or lower, what you find in that is that the diversified portfolio with exposure change clearly has roughly double the performance that equities have, and it has a much smaller biggest drawdown, 21% against 58%. So when you are deciding whether to just be in equities or to be in a diversified portfolio, the diversified portfolio wins by a mile. One of the things that I'd like to point out here is that if you look at the incidence in 2008, you see that markets fell and then returned to value, and you basically get back to roughly where you were in 2008 by roughly 2014. So 6 years later, equities have returned to where they started. So you had a zero return for a 6-year period in equities. In that same period, the diversified portfolio also didn't grow much. It didn't participate in the fall, but it also didn't participate in the pullback. So what you should expect if you're in a portfolio like this is not that you're going to participate every time that markets go up. What will happen is you will participate during the periods of low volatility. So what you would have seen, for instance, if you were invested in something like dynamic parity, which is the flagship for Ironclad, which is our preferred supplier of investment products. It's not a portfolio exactly like this, but it's similar in many ways. What you would have seen is you didn't really participate in the fall in the markets in March, but you also didn't participate in the kickback in markets. So if you look at that last little squeezed bit of the graph, where you see how markets went down and bounced right back, that's actually quite a large drawdown. It's a 35% drawdown, but that 35% drawdown, virtually all of it has been taken back within another 2-month period. So the fastest fall and rise that we've ever seen in markets. So what is the conclusion then that we can draw from all this? We can wrap up with the graphs. The conclusion from all this for our situation at the moment. The first thing is to closely watch the markets and really decide what the next move of the markets will be. Is likely to be a reasonably unprofitable exercise, in the sense that you are likely to get surprised. So the market, first of all, was surprised by the fact that the coronavirus appeared, and it actually fell quite heavily. And then for most economists, the next big surprise is that markets actually go up so quickly after that. So let's maybe quickly spend a little bit of time explaining what happened in that process. So one of the things that we see that is strange in markets is that over the last 10 years, value investing has not performed well. So if you go back over long periods, you always get slightly higher returns if you're a value investor than if you are just investing in the market as a whole. But since 2008, we haven't seen that effect at all. And the main reason for that is that interest rates were becoming lower and lower throughout that period. And what happens is that a value share is typically something that is valuable now, which means that it actually generates cash quickly. Now, if you apply a discount rate to the future cash that you're going to be generating out of any share, which is really the only correct way to value any share, so what cash will I get from the dividends from the share, and how do I discount that back to the current value? If you use a lower discount rate, what happens is that shares that make more money longer term and less money earlier actually increase in value. So therefore, part of what we've seen is that tech shares, which are very often shares where there's an expectation of high earnings in the future, although there isn't much earnings now, those tech shares have done really well, whereas the value shares have done really badly. But effectively, what you would see is that the value shares will not participate in the same way if interest rates are lowered. So a part of what has happened in the last 3 months is that there's been a complete realignment of the expectation for interest rates going fairly far into the future. So the expectation at this point, and I mean, part of it is explicit from the Federal Reserve, the expectation at this point is that interest rates will be zero for the next 5 years in the US, meaning significantly lower than expected just 6 months ago. Now, that lower interest rate environment means that share values, all other things remaining the same, should go higher. So a part of the quick return in share prices has to do with the fact that there's now a strong expectation that interest rates will be lower. The second thing that's happened is that part of the expectation in markets was that when markets next go down, you will actually experience something like the liquidity crunch we saw in 2008 recurring, which is what eventually drove markets down up to 60%. But what's happened is that the authorities, meaning the Federal Reserve and the other big central banks around the world, was also well aware of this expectation and created massive amounts of money in order to ameliorate the liquidity event that came with markets going down. So the massive amount of liquidity created by the banks enabled the return of markets. Now, again, if you are sitting and you have a diversified portfolio, meaning you've got all 4 asset classes in your portfolio, and you are managing your exposure according to volatility, you don't really care about valuations all that much. You care about market behavior. So you may be having a different strategy. So effectively what happens is that at the moment, something like dynamic parity will have very low exposure to markets just because volatility is still very high. Interestingly enough, just as volatility seemed to be going down, we actually in the last week had some a spike in volatility again, a day in which the stock market went down about 7%. And then took most of it back over the next 3 days. So actually a significant return of volatility. Just as volatility goes, anything less than a 1% movement on a specific day in markets would be considered normal or low volatility. As soon as market prices on a daily basis start moving more than 2%, you would regard it as a period of high volatility. So a 5% move in 1 day and then back over the next 2 days would be construed as a period of very high volatility. So what we're seeing is very high volatility. So anything that is sensitive to volatility would have low exposure to markets at the moment. But if you were just looking at it from an economist's point of view, you would still say that the expectation encapsulated in markets for the return of the economy to where it was before seems to be overly optimistic. So on the one hand, what we were saying is interest rates will be lower. Therefore, if everything else was the same, you would expect share prices to be higher. However, we are clear that everything else is not the same, and that's the exact reason why interest rates will be so low. And that is because it's very likely that the world economy will have a great deal of trouble recovering from the current incident, and that there will be a massive reduction in profits. Now, one of the problems that we're going to start facing is that statistics that's released by the authorities will be virtually meaningless. So you see a statistic like retail sales in the US grew 17% in the course of May. Yes, of course it grew 17%, but it actually contracted much more than that in the course of April. So effectively, it becomes extremely difficult to tell whether a specific statistic is positive or negative, because you have to actually compare it to the expectations in markets. So from our point of view, we believe that the core of what you're doing should be to continue to invest into a well-diversified global portfolio in which you have changes in exposure depending on the volatility measures. That will serve you best in the long run, so that should not change. At the same time, we also know that if you look at those graphs that we looked at for shares, if you could come in towards the bottom half of those big drawdowns in share prices, you could have had very good returns just on your equity portfolio as well, even though you took on board quite a lot of volatility. So we still believe that for those investors who want to invest into equities, we still think that the cycle in terms of equities is not finished. We think that there may very well be significant drawdowns still in equities, and there may be a chance to participate in that at some future point. We initially thought that markets should go down 50 to 60% from the top. They went down 35 and bounced back very quickly. Given the amount of liquidity that central banks have created and are likely to keep creating, maybe the bottom end of the market is about 40% down, but we don't think we've seen that level yet. So we still think that markets can be extremely volatile over the next year or so, and that we may well see an opportunity to take an equity punt at some point in the future, but we don't believe that should be your core strategy. Maybe just the last comment on the South African situation and the Rand in all of these things. So the interesting thing is that the Rand in the past, during the crisis, the Rand has always become weak and then returned to reasonable value fairly quickly, and that's really a liquidity issue. So when global liquidity contracts, emerging market currencies will become weak, but that will be a fairly transient event. What we've seen in this case is that liquidity in the large economies never really contracted all that much, which is why equity markets came back so quickly and why we also didn't see a massive drawdowns in things like bond markets. However, liquidity in developing markets was severely impacted. So the Rand going from roughly 14.50 Rand to roughly 19 Rand was part of that liquidity contraction. And as that liquidity has abated, we've seen the Rand move from about 19 to about 17, but there's no reason why we shouldn't see it back in the 15 Rand to 16 Rand range fairly soon as liquidity returns to those emerging markets. However, and that will also obviously impact the South African bond market. So we've seen a great steepening in the South African yield curve, which is leveled off to some extent. So there was a fantastic opportunity to invest into South African government bonds. There's still a good opportunity to invest into South African government bonds, but not quite as good as it was a month ago. So we've seen quite a bit of the potential profit in that come back to us. But we still believe that as the Rand strengthens, we'll see long-term interest rates coming down in South Africa. But what you will see if we look at the graph of the commodity prices, you are likely to see that graph change significantly over the next 3 years. Because one of the things that's happening worldwide, and we're starting to see the announcements as we speak, is that there is a massive amount of investment into infrastructure being announced. So as governments think about the period after the COVID virus, they are thinking that their economies will need a lot of stimulation, and interest rates are already very low, so just stimulating the economy through low interest rates will not be sufficient. So what they want to do is they want to have big infrastructure investment programs in order to stimulate their economies. So what we're likely to see is that over the next 3 to 4 years, there's a global resurgence in infrastructure investment, which will very likely take us back towards something much more similar to the commodity price boom that we saw between 2000 and 2008. So something like the super cycle in commodities will make a comeback through the 2020s. Now, what that will mean is, first of all, most mining companies are classified as value investments. So it may make a contribution to value investing, making a comeback. That's one thing that may happen. But the other thing that will happen is it may very well have a massive positive influence on the South African economy, because our exports will be booming, our natural exports, and it will likely also lead to a significantly stronger rand. So the one thing that we've experienced in the past is, the first thing that you've got to understand about the rand is that it does weaken over the long term. In fact, it has weakened in the long run slightly more than inflation, or the inflation differential, so it has been a weak currency. But within that weakness, there's been massive volatility. So the rand over any 1 year period is typically either the strongest currency or the weakest currency in the world. But the other thing that you have to say is that commodity prices are actually the main driver of the rand's value. So if we think that commodities will make a strong comeback over the next 5 years, we also need to have the possibility in mind that the rand may become quite strong over the next couple of years. And if you took all your money out of the country at 19 rand to the dollar in an unhedged fashion, you might actually be in for a fairly long period of rand underperformance. So I think that effectively what we would say to our clients is still pretty much the normal thing. The first thing you should do is to get your planning in order. Make sure that you have lots of liquidity for the first 6 years, meaning you should be able to tide yourself through a 6-year period of market volatility at all times. So first of all, start out with that. Make sure you've got following distance in place. That's a planning exercise that we would be happy to help you with. The second thing is make sure that your main value preserver is an offshore, well-diversified portfolio that you put in place with the necessary attention to making sure that you don't turn all your rands into dollars at a 2-week point. So have a measured approach to turning your rands into dollars. And then the last comment is that South Africa may not be a bad place to be over the next 10 years from an economic perspective, because if commodity markets were to boom, it would bring about another boom in the South African economy. So creating wealth in the South African economy is likely to still be possible over the next 10 years. So we've got no reason in terms of the current events to deviate from our general proposition that as a South African, you should be creating your wealth in South Africa and preserving it offshore. I think that's it from me. Questions and comments?
Thanks, Wikus. I think we're giving people time to log back in and unmute their microphones. But great, and for those guys who came in a little bit later, just remember that we have a recording, and we'll be sending it off to you probably tomorrow morning. Keith, I'm surprised you haven't made a comment yet.
Let me switch this on. Hi, Lee. Well, I'm just making my notes here of what I want to think through, I'll listen to the recording again. So, no, all very, very interesting. Thank you, Wikus. Quite positive at the end. I like that.
Yeah, I think that effectively, if you just stand back a little, the thing that actually strikes you out of all of these graphs, there are two main things that strikes me. The one is the underperformance that we've seen in equities over the period. And the second was the massive underperformance in commodity prices after 2008, actually over a very long period. So, and one tends to underestimate the influence that has on the South African environment. So if that should turn around, and I was heartened the last week when I saw that Hendrik de Tooy, my old friend from Cambridge days, who's now head of 91, also said that South Africans should be preparing to participate in the commodities boom that will be brought along by the massive infrastructure investments being announced worldwide.
Because one question, just coming to the end there, if you say that you forecast the situation where there's an increase in investment in infrastructure, and I get the logic behind that. What will be the primary source of funding for that? Where will the South African government access the funding? Because you're talking about very significant amounts of money. Where will government source that funding?
Yeah. So maybe just to be very clear, the main source of commodity price rises will not be the South African government's investment into infrastructure, because we're a small country. So from a worldwide perspective, that's not a massive influence. It will be more the fact that in the US and in Europe and in China and in India and in Brazil and all of those other countries, they will do the same. So this is not something that is only South African. But the South African government will also do some of it. And the thing about infrastructure investment from a government point of view is that it strengthens your balance sheet. So what we've seen up to now in the whole COVID experience is disaster relief, meaning governments are spending money to support the people who can't work. That's money that they spend and it's gone forever. And it's just, there's an increase in government debt and you've got nothing to show for it. Infrastructure investment, on the other hand, is different in the sense that you actually have something to show for it. And therefore, it's also much easier to finance. Now, the South African government, interestingly enough, doesn't finance in principle by borrowing from offshore. The South African financial system is well developed, and typically we source most of the financing for our government deficits, we source locally. So we source it in the local bond market. And again, and the Reserve Bank is extremely hesitant to admit this. But in the current circumstances, the South African Reserve Bank is likely to participate in the government bond market. So a portion of the funding will actually come from money printed by the South African Reserve Bank, but it's likely to be in a very responsible way. And like I say, when you get the demands for the South African Reserve Bank to put up a fund for infrastructure investment, etc., the people who put that forward are just uninformed, and they don't understand central banking in any way. But in South Africa, we're also likely to see a lack of demand over the next 2 to 3 years, and therefore it's entirely appropriate for the Reserve Bank to create some money in order to push demand up, and therefore borrowing by the Reserve Bank by the government will to some extent be financed by the South African Reserve Bank. Some of it will be financed by the normal South African saver. And what we see in South Africa, because it's got a well-functioning bond market, the bond market is already reflecting the fact that there will be significant borrowing coming from the South African government. And therefore, we're seeing
That's the question.
So I'll come back to the other question in a second. I just want to quickly finish answering this. The other thing that will happen is there will be money made available by international institutions, such as the IMF and the World Bank and the BRICS Bank, etc., in order to finance infrastructure investment across the globe. So South Africa will participate to some extent in that borrowing, but the bulk of it will actually come from the normal suspects, meaning South African savers will actually finance the bulk of the infrastructure investment in South Africa. I've got another question. Say, what is your assessment of the ongoing political dynamics, the continuing dispute between the US and China, Brexit, and your view on the US elections? So we've got someone who's concerned not about South African politics, but global politics. So that's a fresh breath. Thanks, Millard. We do believe that there is a dysfunction that has crept into the political discourse over the last 20 years, and it's called social media. So social media basically being the most powerful propaganda machine ever that is not being regulated and not being held to truth, etc. And what we've seen as a result is a move worldwide towards more nationalistic leaders. So what you see, for instance, one of the things that should be worrying us is the fact that two nuclear powers, India and China, has come to actually killing each other's soldiers at their border over the last week. So actually the US president should be very concerned about this. But the US president is very concerned about other things. He's much more concerned about what he looks like walking down a ramp than about the fight between India and China. So the thing is that there will be a more nationalistic approach going forward. And that nationalistic approach will mean that we will probably see a contraction in global trade over the next 10 years, or at least a much slower expansion in global trade than we would otherwise have seen. But we do believe that in the short to medium term, from an economic perspective, that will all be smothered by the local policy response of governments to the COVID crisis. So governments are likely to have much larger deficits than they would otherwise have. They will have much bigger infrastructure projects, etc. And yes, there will be an overlay of most of these contracts will not go to the best bidder, but it will go to the local supplier rather than the international supplier. And it does make some economic sense. If you've got high unemployment, you actually want to give the contracts to your local suppliers rather than to the best global bidder. But yes, we do think that politics in general will make a negative impact over the next 10 years, but we do think that it will be smothered by the effect of very strong fiscal intervention from most countries.
Right, thanks, Wikus. I think that may be all for the moment, but will all the attendees feel free to send questions individually, certainly when you get the recording and so on, that you can send those questions and we'll answer them straight away. But thanks everybody for attending on this very cold day. And just to let you know, we will be having another one in a fortnight's time. We're quite busy handling people's problems at the moment and giving them guidance. So we're having them every 2 weeks from now on. And so we'll have another one in a fortnight's time. So thanks everybody for attending.
Lee, just one comment, if I may, on the escalation of the dispute between China and India. I see from today's media that, in fact, although there were 20 deaths on the Indian side, they didn't use weapons. They used sticks and stones, and they literally had a fist fight in territory that's ill-defined. So it seems like a battle that could probably be resolved politically. There's no shooting involved.
You would think that, and I mean, if you think about the Indian-Pakistan thing on the Kashmir border, where the border guards actually spit at each other rather than to shoot at each other. There's all kinds of, but it does clearly point to the fact that tensions have escalated, and the political mechanisms for keeping those tensions under control are less reliable than they were in the past. So I guess the most likely thing is not for this to get out of hand. But if you think about, I mean, the India-Pakistan thing and the India-China thing, the fact that you've got two nuclear-armed powers actually engaging with each other at the border, quite a worrying event. But I just quickly want to answer Innocent's question on the whole question of supply chains. There's every reason to believe that, especially for things like food and medicine, you will have localized production, meaning supply lines will be shortened, more things will be produced locally. Also, what people are likely to do, sensible businesses, will diversify their supply chains, meaning they won't get all their supply of anything from one specific source. But the thing that I would say in terms of commodities is very much driven by where the commodities are found. So if you want iron ore, you've got to get it from the places that have iron ore. So you pretty much get it from Australia or South Africa. You're not going to get a lot of commodities, a lot of iron ore from Japan, for instance. The fact is that for commodities, something like platinum, for instance, South Africa is the main world source of it. So not likely to make a massive difference to our supply of those things. But yes, in terms of manufacturing, I think that there will be a big move towards a diversification of supply chains. And that will actually make the world economy eventually slightly more robust because of the diversified nature. But it's also likely to make it slightly less difficult to keep prices down and slightly more difficult to make quite the same profit that you made before on producing the same stuff. Okay, guys, let's stand back for now. Thank you very much for joining us. We'll see you in 2 weeks' time. We'll think of something interesting to discuss between now and then. But my last comment will be, if you're not confused by now, you clearly have not been paying attention. Thanks a lot.